Hello everyone, and welcome to the third webcast on the recently published discussion paper, Financial Instruments with Characteristics of Equity, or FICE for short. My name is Kumar Dasgupta, Technical Director at the IASB. Today, I'm joined by Choi, Technical Manager at the IASB. In this webcast, we will cover one of the core areas of the discussion paper, classification of derivatives on own equity. But before we start, a couple of housekeeping points. You can download the slides by clicking on the button below the slides window. The webcast is a recording, so we are unable to take any questions from the audience today. And lastly, the views expressed are those of the presenters, not necessarily those of the board or the IFRS Foundation. This webcast is the third in the series of webcasts exploring the FICE discussion paper. In the first webcast, we provided a brief overview of the discussion paper, covering why the board is doing this project, the scope of the project, and how the preliminary views in the discussion paper compare with IAS 32. In the second webcast, we covered the key parts of the board's preferred approach to classification. We also talked about how the board's preferred approach would classify non-derivative financial instruments and looked at some examples. In the coming weeks, we will look at classification of compound instruments and redemption obligation arrangements, the board's proposals around the presentation requirements for equity instruments and those for financial liabilities. In this webcast, we will consider the classification of derivatives on own equity and provide an overview of how the board's preferred approach would address the classification of such derivatives. This webcast covers all own equity derivatives, except those that include an obligation for an entity to take back its own shares, which will be covered in a later webcast. So today we are covering section 4 of the discussion paper. So what are derivatives on own equity? These include derivatives that are settled in an entity's own shares. So for example, if an entity issues share warrants to deliver own shares in exchange for cash on settlement, that is an own equity derivative. Own equity derivatives also include derivatives that are not settled in own shares, but that have own shares as the underlying. For example, a derivative that references own equity, but that is net settled in cash. Derivatives on own equity exist in various forms in how they are settled and whether their exercise is conditional. They could be gross physically settled, for example, where shares are delivered in exchange for cash on settlement, or net settled in cash or shares. Also, the exercise of own equity derivatives can be unconditional, like in a forward contract to sell own shares, or could be conditional depending on the holder or the issuer. Or the exercise could depend on an uncertain future event that is beyond the control of both the holder and the issuer entity. Derivatives on own equity can be considered as an exchange comprising two legs. So in the case of a gross physically settled derivative, one leg would be the receipt or delivery of equity instruments. The other leg would be receipt or delivery of cash or another financial asset. Consequently, derivatives on own equity combine both an equity leg and an asset or liability leg. Therefore, classifying them in their entirety as either equity or derivative asset liabilities will always result in certain anomalies. That is because if the equity leg and the asset leg had existed independently, the financial reporting consequences would have been different. For example, changes in the value of the asset or liability leg would meet the definition of income and expense and would be recognized as such, while changes in the equity leg would not. These anomalies will exist unless the individual legs of derivatives are classified separately. The board considered but rejected classifying individual legs of an own equity derivative separately, not least because of the complexity that it would introduce. Applying the board's preferred approach, derivatives on own equity would continue to be classified in their entirety as in other IFRS standards and as is the case for IAS 32 today. Applying IAS 32, only those derivatives that meet the so-called fixed for fixed condition are classified as equity instruments. That is a derivative that will be settled only by the issuer exchanging a fixed amount of cash or another financial asset for a fixed number of its own equity instruments. When applying this condition in practice, questions arose such as what does fixed mean in the fixed for fixed condition, as IAS 32 does not define the meaning of fixed or explain the rationale for the condition. Under the board's preferred approach, the same classification principle would apply to all own equity derivatives, whether standalone or embedded derivatives that are separated from a host contract. The key test will be what drives the value of the derivative on settlement. We call this the net amount. The discussion paper focuses on whether the net amount of a derivative on own equity is affected by any variable that is independent of the entity's available economic resources. As a consequence of the decision to classify derivatives on own equity in their entirety and not separately classify individual legs, an entity would need to consider the combined effects of the two legs to determine the amount of such derivatives. In its simplest form, the question asked is whether the net value of the derivative on settlement changes only due to changes in the value of the entity's own shares. The simplest and probably most common example to think of would be a derivative to deliver a fixed number of the entity's own shares in exchange for receiving a fixed amount of cash in the entity's functional currency. Changes in the value of the derivative on settlement is driven only by changes in the entity's own share price. While the term fixed for fixed isn't used, applying the board's preferred approach, a fixed for fixed derivative will continue to be classified as equity. We will look at why in due course. Further to that, the board's preferred approach will clarify whether some variables preclude or do not preclude the equity classification. We will discuss some of these later in this webcast. Now, I will hand over to Uni to take us through the rest of the webcast.
On this slide, we set out the classification principles for derivatives on equity. Like non-derivative financial instruments, the classification principle for derivative uses the timing and the amount features. In like non-derivatives, if you have either one or both of the features of financial liability, the derivative instrument is classified as a derivative liability or a derivative asset. But unlike non-derivative instruments, classification of on-equity derivatives will require assessing whether each variable affecting the net amount of the derivative is independent of the entity's available economic resources. This is effectively a special way of thinking about the amount feature in the context of derivatives. Let's consider these two tests one at a time. Assessment of the timing feature is most straightforward. That is, if an on-equity derivative is net settled in cash, the derivative would be classified as a derivative financial asset or liability. That is because there is an obligation to pay or a right to receive cash. In other cases, if an on-equity derivative is not net settled in cash, the entity would need to assess the amount feature to determine its classification. The simplest way to think about the amount feature test would be to think about variables that could affect the settlement value or the net amount of a derivative and test if that is affected by any variable other than the entity's own share price. Consider a derivative to deliver a fixed number of shares in exchange for receiving a fixed amount of cash in the entity's functional currency. The only variable that affects the value of the derivative on settlement date is the entity's own share price. Such a derivative is not affected by any variable that is independent of the entity's available economic resources, so the derivative has neither the amount nor the timing feature of a financial liability, and so the instrument is classified as an equity instrument. Let's consider some examples. So the first example is, an entity writes an option to sell 5 own shares. If the holder exercises the option, the entity would physically deliver 5 own shares and receive 100 currency units in the entity's functional currency. The derivative is cross-physically settled. So now let's ask the two questions. 1. Whether the net amount creates an obligation to transfer cash. The answer is no, because the contract is settled on a gross basis, the entity delivers own shares and does not have an obligation to transfer cash or another financial asset. 2. Whether the net amount is affected by any independent variable, that is, any variable other than on share price. The answer is no. Looking at the asset leg does not introduce a variable that affects the net amount because it is a fixed amount of cash in the entity's functional currency. And since the equity leg is a delivery of fixed number of ordinary shares of the entity, the amount of the equity leg is determined by the ordinary shares' rights to the pro rata share of the net asset of the entity. Therefore, the only variable affecting the net amount of the derivative is changes in the entity's available economic resources. So the net amount of this derivative is not affected by any variable that is independent of the entity's available economic resources. Because you've answered no to both questions, the derivative would be classified as an equity instrument applying the board's preferred approach. This classification outcome is consistent with IAS 32. Example number 2 is where an entity writes an option to sell 5 own shares for 100 currency units in the entity's functional currency, which is net cash settled. Let's ask the same questions. Question number 1, whether the net amount creates an obligation to transfer cash. The answer is yes, because the contract is settled on a net basis and in cash. By writing such an option, the entity has assumed an unavoidable obligation to transfer cash, which would crystallize if the holder exercises the option. Question number 2, whether the net amount is affected by any independent variable. The answer is no, for the same reason as example number 1. Because of the timing feature, the derivative would be classified as a derivative financial liability. This classification outcome is also consistent with IAS 32. Example number 3 is the derivative with similar exchange as example number 1 and 2, but is net settled in shares. So on settlement, the net amount of the derivative is paid in the entity's own shares. Let's ask the same 2 questions. Question number 1, whether the net amount creates an obligation to transfer cash. The answer is no, because the contract is settled in the entity's own shares. The entity does not have an obligation to transfer cash or another financial asset. Question number 2, whether the net amount is affected by any independent variable. The answer is no, for the same reason as examples 1 and 2. Because you've answered no to both questions, the derivative would be classified as an equity instrument, applying the board's preferred approach. This is a change compared with IAS 32. Applying IAS 32, net share settled derivatives are classified as derivatives assets or liabilities. Okay, example 4. An entity writes an option to sell 5 own shares for receiving 100 units of foreign currency. So on settlement, if the option is exercised, the entity will deliver 5 of its own shares and receive 100 units of foreign currency. Let's go through the 2 questions. Question 1, whether the net amount creates an obligation for the entity to transfer cash. The answer is no. Because the contract is settled on a gross basis, the entity delivers own shares, not cash. Question number 2, whether the net amount is affected by any independent variable. The answer is yes, because a foreign currency exchange rate affects the net amount of the derivative, and that rate changes independently of the entity's available economic resources. Applying the board's preferred approach, all derivative with the net amount affected by a foreign currency variable is classified as a derivative asset or liability. The board's preliminary view is to apply this classification principle consistently to all derivatives without retaining the FX rights issue exception that exists in IAS 32 today. At the same time, the board is considering presentation requirements to separately present income and expenses arising from some of such derivatives, subject to particular criteria. We will cover these presentation proposals in further detail in a future webcast. In addition to foreign currency variables, the discussion paper considers other variables as examples in whether they are considered independent of the entity's available economic resources. The discussion paper makes it clear that some variables are considered independent of the entity's available economic resources in all circumstances, while others require further analysis. As an example, in addition to foreign currency, if a variable depends on a specific part of the total economic resources of the entity, but does not consider all other claims, such a variable is an independent variable. For example, earnings before interest and tax, or EBIT, is a financial measure that considers changes in the entity's economic resources but does not consider the effect of other claims such as interest on debt. So if the net amount of a derivative is affected by EBIT, the net amount of the derivative is affected by an independent variable and would be classified as a derivative financial asset or liability. There are some variables that require further analysis, such as if the number of equity instruments to be delivered is adjusted in a dilution event or in the event dividends are paid to existing shareholders. The entity would need to consider the effect of such variable and how it affects the net amount to determine whether the presence of such variables preclude equity classification. The discussion paper also discusses contingencies. If a derivative is affected by any contingencies, the entity should consider whether, and if so how, the contingencies affect the timing and the amount feature of the derivative. If a contingency does not affect the timing and the amount feature of a derivative, the contingency does not affect the classification of the derivative. For example, the exercise of a written option depends on the holder's decision, but such a contingency does not affect the classification of the derivatives. Let's look at another example which is covered in section 4 of the discussion paper. An entity issues a derivative that requires the entity to deliver 5% of its issued shares for a fixed amount of cash in the entity's functional currency. If the number of issued shares change during the life of the derivative, the number of shares that would be required to be delivered would change, so the number of shares is variable. The derivative, if exercised, will be gross physically settled. Let's ask two questions. One, whether the net amount creates an obligation to transfer cash. The answer is no, because the contract is settled on a gross basis. The entity delivers on shares. 2. Whether the net amount is affected by any independent variable. The answer is no. The other leg does not introduce a variable that affects the net amount because it is a fixed amount of cash in the entity's functional currency. Looking at the equity leg, by promising a fixed proportion of the entity's shares on issue, the equity leg will only be affected by changes in the entity's available economic resources. If the entity issues more shares, so that the total number of shares on issue increases, the derivative would require the entity to deliver more shares. However, regardless of the number of shares to be delivered, the derivative would always require the entity to deliver 5% of the entity's available economic resources. The net amount of this derivative is therefore unaffected by any variable that is independent of the entity's available economic resources. Because you've answered no to both questions, the derivative would be classified as an equity instrument applying the board's preferred approach. This is an example where the fixed for fixed words in IAS 32 have been difficult to apply. Let's look at another example from section 4 of the discussion paper. An entity issues an option that requires the entity to deliver 100 own shares in exchange for receiving a fixed amount of cash. The derivative contains a feature that adjusts the number of shares to be delivered so that the holder receives shares worth at least 100 currency units in all circumstances. So the derivative guarantees 100 currency units as a minimum amount of value to be received by the holder. The option is settled on a gross basis. If exercised, the entity delivers own shares and receives cash. Let's ask two questions. One, whether the net amount creates an obligation to transfer cash. The answer is no, because the contract is settled on a gross basis. The entity delivers own shares on settlement. Question number 2, whether the net amount is affected by any independent variable. The answer is yes. The other leg does not introduce a variable that affects the net amount because it is a fixed amount of cash in the entity's functional currency. Looking at the equity leg, the adjustment to the number of equity to be delivered creates an obligation to deliver at least 100 currency unit worth of own shares. Such an obligation is independent of the entity's available economic resources because there are circumstances when the amount of the obligation does not change in response to changes in the entity's available economic resources. Because of the amount feature, the derivative would be classified as a derivative financial liability applying the board's preferred approach.
Thank you, Yuni. Over the next few slides, we provide a classification comparison with IAS 32 and the board's preferred approach. Please note that while the form of settlement varies as described, the derivative in each case involves a fixed functional currency leg and a fixed number of own shares leg. So none of the examples have the net amount affected by any variable independent of the entity's available economic resources. We have gone through these variations on written call options using our examples 1 to 3 earlier in our webcast. This slide considers classification of purchased options. The entity would still ask the same two questions to determine its classification. You will notice the change in the classification of net share settled derivatives when compared to IAS 32. The reason for the change is the same as the reason for the change in the classification of net share settled written call options that was analyzed in example 3. The classification analysis for a forward contract will also be similar, and the classification for net share settled forwards will change when compared with IAS 32. So, in the upcoming webcasts, we will cover classification of compound instruments and redemption obligation arrangements under the board's preferred approach. Also, we will talk about how presentation of financial liabilities and equity instruments can be used to provide additional information about financial instruments to supplement information provided by classification. So, thank you for listening, and we hope you found it useful. Stay tuned for more webcasts in the coming weeks.